Hey guys, in this video, I'm going to show you why I am so thrilled about REITs. All right, this is going to be kind of an off the cuff video. So as some of you guys might know, I'm huge into REITs. These are real estate investment trusts. These are traded on the stock exchange, just like any other ordinary stock. The only difference is that these companies, they go out and purchase income producing real estate, then they rent it out, and then, you as a shareholder of that REIT, you get paid out a dividend. Now, the beauty of that is that you're actually an indirect owner in that real estate, right? Because if you invest into a REIT, that REIT is going to go out and purchase, actual real estate. So, you owning the REIT, you are indirectly owning that real estate. Now, unfortunately, there's not that many tax benefits associated with investing in REITs, which for me is perfectly fine. I'm a huge real estate investor. I really like investing into real estate. It's one of my favorite asset classes. So I just want to share with you guys some of the research that I use to come to my conclusion about building out an entire REIT portfolio. And I'm going to show you guys my real money REIT portfolio here in just a second. So let's get into the research that I used, came across, and helped me come to my own conclusions. All right, so let's get into it. So this is a article by the Motley Fool. Let me move my head over here. By the Motley Fool, and it's basically comparing REITs to the S&P 500. Now, the FTSE NAREIT, All Equity REIT Index or benchmark, whatever you want to call it. NAREIT is the National Association for Real Estate Investment Trusts, and then they compared their total returns to the S&P 500. And a lot of people would be surprised to know that real estate is actually outperformed the S&P 500 over long periods of time too, right? So as we see here, over 50 years, REITs have actually returned 12.7% over the S&P 500's 10.2%. Now that's pretty cool. In my mind, that's further proof that real estate is a wealth compounder. Why might REITs be outperforming the S&P 500 over long periods of time? Well, REITs have to pay out 90% of their taxable income to shareholders in the form of a dividend, right? And typically what you can do, reinvest those dividends, right? Compound your wealth much quicker. So you have to keep in mind that REITs are total return vehicles. All right, you can't really think in the short term, 2, 3, 4 years. You have to have a real long-term mindset when you invest in the REITs. All right, so looking more at the data, we have 11.4% over the past 25 years. Over the past 20 years, this is 9.7% for the S&P 500, and then 10.4% for the REITs. Now, it's within the last 10 years that REITs, it's inverse correlation, not correlation, but inverse returns. The S&P 500 outperforms, but again, you have to also take this into account. This is through recessions, the great financial crisis of 2008, 2009, the real estate collapse, the dot-com bubble burst, the 90s, and even more recent was the pandemic that we had. And REITs are still outperforming, or REITs are still performing very well. All right. And REITs, they invest in so many different sectors. So I'm going to show you my portfolio here in a second and kind of show you all the sectors that I'm invested into. But REITs, very likely you either have been in a REIT yourself. If you're watching this video, very likely the internet is passing through either a fiber network that's owned by a REIT, or it's passing through a data center that's owned by a REIT. If you make a phone call, on your cell phone, very likely you're going to be hitting a cell tower that's owned by a REIT. If you go to, Walgreens, Texas Roadhouse, probably CVS, Dollar General, Family Dollar, very likely you're walking into a building that's owned by a REIT. REITs are used in everyday life, and we just don't stop to know that or appreciate that. So anyways, I wanted to show you this chart because it is kind of eye-opening. In the personal finance space, the investing space, everyone's always talking about, just invest in the S&P 500, invest in the S&P 500. That's really good advice. That's not bad advice. But, there are other investments out there that you could make. I'm not saying go out and buy a REIT ETF, because REIT ETFs, I don't know if they have the same kind of return profile that individual REITs would have, which I'll show you here in a moment. But I just wanted at least to show you this and why I'm really bullish on REITs. All right, so let me show you another graph here. So this is, again, let me pull up a pen here. we'll go red today. So this is right from REITs website. So again, they're the National Association for Real Estate Investment Trusts. And I know what some people might be thinking, especially if you own rental properties. This chart might rub you off the wrong way. I used to own rental properties. I pretty much sold all my rental properties, moved all the money into REITs. So here's the return profiles of REITs versus private owned real estate. Okay, so we have the NCREIF, which is the National Council of Real Estate Investment Fiduciaries. They track a property index of, basically investments into, residential properties, warehouses, industrial, retail, all that kind of stuff. And then you have ODCE, which is it's pronounced Odyssey, but this is open-ended diversified core funds. So these funds, think of them like a private ETF. And when you invest into this fund, this fund owns like a multitude of different types of real estate, apartment buildings, probably shopping centers, malls, office buildings, the whole sort. Now, the thing about the Odyssey fund, and again, that's this fund, is that they're investing in core, all right? Diversified core. Whoops, sorry. But they're investing in diversified core. Core means that these are stabilized assets. There's no value add. There's no tremendous upside to them. They're very, they're in really good neighborhoods, really good cities. Again, they're very stable assets. All right, so let's compare how REITs performed against these private real estate funds. All right, so we don't really care about this right now, but we care about the long-term performance. And if we look at the long-term performance, REITs actually outperformed all of them over a 20-year period. That is ridiculous, right? So that's even if you owned a rental property. REITs probably outperformed you. And I know there's a lot of real estate investors out there who will watch this video and be like,
what? No, bro, that's a lie. I don't believe it. That's not true. Rental properties, I get 20% on my money. I'm making 20% returns in cash flow and tax benefits and yada, yada, yada.
I totally get it. But here's the truth. In real estate, especially rental properties, you're going to have tenants. The tenants typically sometimes damage the property. And, summarized, let me just summarize this point. That one repair can wipe out a year's worth of cash flow. So yes, on paper, some investors might be making 20% returns, but when you actually look at the books or look at the numbers, probably tells a different story. And that's not all rental properties. All right. Your experience may vary. I had a pretty good experience with rental properties until I didn't. So again, it depends on how you buy and all that stuff. I'm not going to go into it in this video because I can go on and on about it. But I wanted to at least show you guys that REITs are outperforming private funds and private real estate. That's a big deal. All right. Huge deal. Okay. So this is the research, and I'll put these links down below in the description for you guys. So let's take a look at my all REIT money portfolio. All right. So this is a live portfolio. All right, let me zoom out here for a second. All right. So, these massive bumps you can see here are, me investing huge sums of cash, probably from the sale of my real estate. But yeah, this is pretty much it. So I want to show you guys all the different kind of REITs out there, because not everyone really knows or understands REITs. And I feel like they're one of the most misunderstood assets out there. A lot of people can get some huge value from these. So let me just quickly go down this list, and then I'm going to go back to something to show you kind of the returns of a single REIT versus the S&P 500 index. And we'll even throw in a dividend paying company, right? A popular one too. All right. So we have cell tower REITs. Again, these are REITs. They own cell towers. So if you're making a phone call, very likely you're hitting these things. We have industrial REITs, big warehouses. Amazon, needs logistics. They need warehouses to store all their stuff. These REITs, the more popular one being PLD or Prologis, they own warehouses all over the world, all over the world. And they're big, they're massive. And, but whenever you order something off Amazon, very likely that package is probably going to be coming from a building that's owned by a REIT. Again, just REITs are everywhere. They're used in everyday life. Apartment REITs, I don't have to go too much into it. You guys know everyone needs a place to live. These are your multifamily apartment complexes, very nice, very grade A, swimming pools, all that jazz. These all these are like, they own real estate throughout the United States. Some are more concentrated than others. Like I believe MAA is more concentrated on the Sun Belt region. ESS, Essex Property Trust, they're more concentrated in California and on the West Coast. So you have REITs that own thousands of apartment units. So when you invest into a REIT, instead of having a $20,000 or $25,000 down payment to purchase a piece of property, you can invest into a REIT and get instant diversification across thousands of apartment units. All right. We have storage REITs, public storage, self-storage, that kind of stuff. Whenever you need to like store stuff, businesses also use this. If, they need to store their construction equipment, they can go to a storage facility. Triple net lease, again, retail, manufactured housing. These are mobile home parks, strip center REITs. These are like shopping centers, huge shopping centers. They might have a movie theater. They'll have like a couple, posh restaurants, maybe even a couple apartments. And, they'll also have like a bunch of retail shops. Biotech lab REIT. I mean, this gets mixed up with the office REITs. I kind of explained this in my last video, but basically biotech lab, casino gambling, single family, and then cannabis REITs, which is my riskiest position. But I want to show you guys something that is kind of interesting. So let's look. You may not have been aware of another tool out there. Is like a backtest portfolio analyzer. Basically, that one, they ended up going to more of a premium model. So you can only backtest for 10 years. But this is a free version of another one called valueinvesting.io /backtest. Really useful tool, especially if you want to compare kind of like how companies would do ETFs or, different asset classes. You could put GLD in here, for example, which is a gold ETF. So I kind of already pre-filled this out for you guys, and I did cherry pick. So I went with Avalon Bay Communities. It's one of my picks for my apartment REIT portfolio, and we're going to compare it against the S&P 500. All right, and then on the next round, I'm going to include a dividend stock that is probably well known by all. All right, so we're just going to compare these two and see how they do. Right, so again, we're going to hit backtest portfolio. Hopefully it loads fast. There we go. So we're backtesting from April 94 to September of 2024. And as you guys can see, the REIT, and this is without adding any other money. All right, this is without adding any money. We're only reinvesting the dividend. Okay, the REIT would have an ending balance of $348,000, whereas the S&P 500 would only have $223,000. Now, again, there's a lot of risk. There's a lot of caveats to this, because what if Avalon Bay went bankrupt tomorrow? You're concentrating in a single stock. Yes, those are real risks, and I don't recommend people do that for sure. But I just want to show kind of the compounding power that REITs have, that real estate has. All right, real estate has against the stock market, the greater stock market. So as you can see, ending balance, huge, right? And this was obviously during the recession, or not recession, the pandemic, right? This was 2008, 2009. And it's just been compounding like crazy. And obviously this right here is the bear market that REITs have been in for quite some time. And my portfolio kind of also shows this. But let's add a well-known dividend-paying company. Let's go with Coca-Cola, right? Because Warren Buffett owns this. This is like the most popular of the popular out there. So let's go with Coke and just see how this all compares to each other. So we're going to go with Coke. We're going to add 100%. And let's backtest his portfolio. Hopefully it loads. There we go. All right. So again, we're backtesting from April 94 to 2024. And I think that's just because Avalon Bay Communities, that's when it IPO'd. And then that's when it was getting tracked. So that's why that track stops there. So if we look, Avalon Bay, the E-REIT, Avalon Bay Communities returned $348,000. The benchmark S&P 500 returned $223,000. Coca-Cola only returned $150,000. And that's with dividends reinvested. All right. If we look at the chart or the graph or whatever, the line chart, I guess, you could see it. All right. So, the whole reason why I'm so bullish on REITs is because of the compounding power that real estate has for everyday investors. When REITs came out at the 1960s, President Eisenhower came out with the Cigar Act or something like that, cigar extension, and rolled up in that extension was the formation of REITs. And basically, what this allowed was for everyday investors to be able to have access to institutional quality real estate through the stock market. And that's how REITs came about. But for some odd reason, it's just REITs seem to be unloved by the greater majority of, investors. Most people are like investing in super sexy stocks, like high flying tech stocks. They're investing in blue chips and, dividend aristocrats and dividend kings and all those other things and cover call ETFs and blah, blah, blah. Right. But nobody stops to think about REITs. And the beauty of REITs also is that it can create passive income for you. It can create a lot of passive income for you if you let it compound over time. And I get it, this is 30 years worth of data, right? This is 30 years worth of compounding. Of course, if you can get there much quicker if you invest more money, right? And I'm not saying you should just go all 100% into REITs either, because there's risk there, right? There's a lot of risk. You can underperform the greater stock market some years. And depending if you're investing into an ETF or individual REITs, there's risk there too, because what if the REIT does bad and it just crashes tomorrow and you lose 50% up to 90% of your value? I've seen that. You can look up Pennsylvania REIT, which the ticker used to be PEI, but it's now delisted. They lost 99% of their value and they got delisted, right? Doesn't happen to REITs very often, but it does happen and it can happen. Another one that had a dramatic crash was Medical Properties Trust, MPW. They're on the return, but they saw a huge drop in their share price, and it scared off a lot of investors. So there's risk. You got to kind of take it all in, decide what's best for you. For me, I'm a real estate investor, so I invest in real estate syndications. I invest in rental properties, not so much rental property stuff anymore because I live overseas, and I invest into REITs. So I hope this video was good for you guys. A quick shout out if you guys are interested in a free Skool community. I'll put a link down below in the description. Just quick couple of important tips for you guys. You should always consider probably an ETF version if you're going to invest into anything, so it takes away a lot of the guesswork. Some of the popular ETFs out there is VNQ, USRT, which is iShares core US equity REIT ETF. VNQ is Vanguard's real estate ETF, and I think there's one more out there. I can't remember the name, but you should always consider these ETFs first before investing into individual REITs to lower your risk. And of course, hope you guys have a great day. Please let me know if you're investing in a REITs, and if so, which ones are you investing down below. All right, guys, I'll see you in the next video. Peace.